Hey everyone, thanks for joining us. I'm Chris Hill here with Chief Investment Officer Andy Cross. Welcome to Fool Global Headquarters here in Alexandria, Virginia. We're going to be taking your questions. Go ahead and type those into the chat box. But first, we're going to talk about monster growth stocks. Last time we were in the studio, we were talking about dividend-paying stocks. A lot of benefits to dividend payers, including the stability. A lot of big companies, stable businesses that aren't really going anywhere. Today we're talking about monster growth stocks, a little bit more risk involved, but also the rewards when the growth stocks pay off are really incredible.
Well, Chris, that's right. When you think about the areas of the market over the last 10, 20, 30 years, it really has pivoted to these big growers, both earnings and sales, companies that can grow and compound over time. That eventually reflects in the stock price. And that part of the market really, especially as technology has become more and more prevalent, has really started to be the place where investors are going for the return. So we've started to see the shift away from dividends more towards companies that can really grow sales and earnings at very high rates for very long periods of time.
You and I were talking before we started taping. It really, a lot of times it breaks down into those two basic categories. You've got the companies that are turning a profit and they are compounding those profits. You've got the companies that maybe aren't profitable yet, but they're growing that top line revenue in an incredible way. Let's start with the earnings compounders, because I think particularly for people who are new to investing or they're just starting out, they're maybe a little bit more comfortable with companies that are profitable right out of the gate.
Yeah, that's right, Chris. So when you think about just theory of investing is that a company generates profits, and over time those profits accrue back to the shareholders, and the shareholders win by the stock outperforming and performing well based on how fast and how long those companies can grow the earnings. So I consider these earnings excellent, these earnings compounders. Companies such as Starbucks, Visa, Home Depot, Ulta Beauty, Booking.com, the owner and operator of Priceline. These are companies that, just looking over the last 10 years, Chris, have grown earnings north of 20, 25, 30% per year. And if you look at the stock performance, it often tracks that earnings growth. So these are well-established companies that really over time can grow earnings at very high rates, and they can reinvest that capital back. The sales growth maybe not nearly as high, but because of the way the business models work and the markets they are serving, they can grow those earnings for really very long periods of time, and I call those earnings compounders.
Well, and let's take a couple of those businesses and dig into them a little more, because you think about whether it's a company like Visa or Booking Holdings, as you said, parent company, better known as Priceline.com.
Yes, right.
Not only are they compounding machines, but they are also in industries and taking advantage of trends that have a long runway in front of them. In the case of Visa, it's more and more people not using cash, going digital. In the case of Priceline, Booking Holdings, that was a company that got out early in the trend of online travel booking and really expanding, not just here in the US, but around the world.
Well, when you think about a company like Home Depot, which has benefited so much from the growth of housing, even through the financial crisis, that crisis was driven by a bubble in the housing market. So companies that can really benefit from those growth trends, so they can grow sales, and all these companies do grow sales, but really what I think investors have been rewarding them for over time is the growth in the earnings. And those earnings that they can redeploy, invest back into the business to continue to grow the business at higher and higher rates, and they can expand their margins over time. Not many companies can expand margins for 5, 10, 15, 20 years over time. So when you think about the ability for these companies to be more profitable over time, that ultimately is going to end up showing the earnings growth, and investors are going to reward that. And like the companies I mentioned, they've been able to do it for 10, 20, sometimes 10, 20 years at a clip. So those kinds of companies can ultimately lead to an investor having a very nice portfolio.
All right, the other type of growth stock that we were talking about earlier was the ones who are growing sales. They're growing that top line revenue. They're not profitable yet, but they see a pathway towards that profitability. Again, for a lot of investors, it's a little unsettling to be like, okay, they're not actually making money, and I'm taking a leap of faith that at some point they're going to be able to turn that on.
Well, and the market, I think, rewards those sales growers. So these are the companies that I think when people think traditional high growth stories, these are the ones I'm talking about. The Shopifys of the world, the Oktas, Appian, those are all recommendations here at the Motley Fool. Twilio, Ellie Mae, although Ellie Mae is profitable, Splunk, Mercado Libre. These are businesses that can grow 25, 30% at a clip, very high levels. They may not be making money now, but based on experience and the leadership teams, investors having patience to be like, okay, it's okay. I eventually will see those profits accrue to me and accrue to the business, and I'm going to benefit that way. In the meantime, they're going to continue to grow sales at very high levels, and the stock gets continually rewarded for that performance. And then you see this performance of, like we've seen for so many businesses over the last 5 years, especially those based in technology.
Another thing you mentioned to me before we started taping was the companies that are essentially hybrids of the two things we just talked about. And maybe the most obvious example is Amazon, which was not profitable for so many years. A lot of people on Wall Street saying, when are these guys ever going to make any money? Now they're doing that in a pretty solid way. They're not the only ones who are sort of those hybrids of earnings compounders and being able to grow that top.
Chris, these are what I call the hybrid heroes. I mean, these are the kinds of businesses you really, I mean, these are the ones that can just make your portfolio. So the company like Salesforce.com, Amazon, Netflix, a company I follow, EPAM System. Facebook was actually one of these right out of the gate when it became public, was very profitable. Apple the same way, grows sales at 20% a year for 10 years and earnings at 27%. So when you think about just some context, Chris, the average company in the S&P 500 probably can grow sales at maybe 5%, 5 to 10% over time. Profits at about the same level because they can't expand margins. But these businesses like Salesforce, you just look at what it's done, growing sales 29% a year for 10 years and earnings more than 30%. So these kinds of, and that obviously has been rewarded in the market by patient investors like those hopefully watching the show and have listened to our advice here. But these are the kind of businesses, they are attacking markets. They have leadership teams that are principled, aggressive, they delighting customers, and they can grow these sales and turn that right into profits over time, and then that ultimately helps shareholders.
I'm glad you mentioned the management, because that's something that we always love to see here at the Motley Fool is great management that has a stake in what they're actually doing at the business. Ideally, it's a founder-led company, but not all of these companies that we've talked about are necessarily founder-led. That doesn't mean they don't have great growth potential. What are some of the other things, what are the other factors investors, viewers should be watching for when they're looking for growth stocks?
Well, Chris, you teed off our conversation talking about the market opportunities. So one thing that we look for, and I think many of us at the Motley Fool understand, is trying to find companies that are serving a market that is really growing, that will continue to grow for many, many years, is going to be changing, and that a company can operate in the growth market, deliver the kind of services that are going to be able to take market share in a growing market. So if you have that combination of a market that is expanding and companies that can take more and more market share, often from legacy performers and maybe a little bit more of the staid companies that aren't acting as aggressively, that's probably the biggest factor I look for. I look for these market opportunities, and then, like you said, you want the founders who have a lot of ownership in the business. Ideally, that's been great. We mentioned some of those earlier on. And the financial performance can't be overlooked. You need companies that can deliver the solutions and then into a financial model that ultimately is going to continue to support the sales growth and the financial performance. One thing David Gardner looks for when he talks about his 6 signs of a rule breaker, one of the very first ones he looks for is this idea of a top dog and a first mover. So someone who's really going after a market and basically inventing the market. Salesforce basically invented the market for customer relationships management software and cloud-based solutions, and we can see where that market is today. So if you can find teams and businesses that are operating in these big market opportunities, they do have these first mover characteristics, and they have both a management team that can deliver the solutions that customers want and the financial model that can back it. That right there is just the secret sauce for finding great growth companies.
Well, and you mentioned the financial performance of the company. That ties into another thing that David Gardner says he likes to look for, which is the stock appreciation. Because a lot of times investors look at a growth stock that's had a great 6 months, 12 months, that sort of thing, and it's easy to think, particularly with a lot of financial media saying, boy, that thing's had a great run, and so naturally we think, well, okay, well, I don't want to jump in now.
That's
I want
right.
to wait for it to dip. But actually, share price appreciation in the past is actually something he likes to look for.
Well, and statistically, and studies have shown in the short term, it actually is a great way to be able to invest, or a good way to be able to invest and find some of these great growth companies. But in our perspective, the twist we add to it is, as long-term shareholders, so many of the media that you talked about, Chris, mentioned about calling a company totally overvalued, or a company that has gotten ahead of itself, or a company that the stock is now, I missed it. I missed it. Now it's up 35% or maybe even double, and I missed that opportunity. Well, those are companies that tend to have been performing well, as I just talked about the financial performance. So if they are performing well, that's often, not always, but often a good indicator that they're doing something right. They have the good management teams that will be able to continue that success in the future. And so don't be scared by past appreciation. What really matters in the stock, what really matters is where the business is going from here on forward, and the kinds of market opportunities and solutions they're delivering for their customers. If that continues to have success, the stock price often will track that success as well. You look at a stock like Salesforce I mentioned earlier. That stock really has never ever looked cheap to traditional metrics. And I'm sure if you go back over the last 10 years, there were plenty of times that was called overvalued, and the stock got ahead of itself, and yet that stock is up almost 19 times in value over the last 10 years.
We're going to be taking your questions in just a moment, so keep those coming. I know a lot of good questions are already in the queue. One thing I wanted to touch on before we get to the Q&A from the audience, some of the names that we've been talking about here are names that everybody is familiar with, even if you're not an investor. Netflix, Amazon,
Right.
Starbucks, Facebook, Apple. I mean, these are all very strong consumer brands. Some of the other names, not really consumer brands. Salesforce.com, Twilio. It does seem, however, though, that the one thing that those have in common is they all have customers.
Yep.
Some of them are everyday folks like you and me, but some of them you kind of have to look for. But it seems like what ties them together when it comes to growth stock potential is the customers who are buying the goods and services are happy with what they're getting.
Yeah, absolutely, Chris. When you think about trying to understand what make one business better or different than another business, one thing we do like to look at is consumer appeal, and whether that consumer is like a you and me consumer shopping at online, or it's actually maybe a B2B business to business provider, more like the Salesforce or more like a Twilio. Finding companies that continue to add to their client base. Okta is one, which does customer identity management and security solutions, helps, including the Motley Fool, helps thousands of customers manage their employee logins. That is a business that continues to add more and more people and add solutions and grow at scale in ways that I think, even though they're not profitable over time, will really benefit because they continue to deliver solutions that their customers want to have. So you really have to do that. Everybody says they can do that, but if you look again, and I'm talking over 10, 20-year periods, finding the businesses and the management teams that can do that time and time again, learn from their mistakes. I mean, look at the mistake Netflix made with Quickster. I mean, like, they don't always get it right, and sometimes that's a great time to be thinking about buying the stock. But they do it more right than wrong, and they do it for long periods of time. And that's where the founder ownership, Chris, is so important, because you have founders who own parts of that business or a large part of that business, and they have the patience and the investing base who has faith in those founders to be able to get it right.
All right, we've held off long enough in terms of taking questions from the audience. Let's start with this. A couple people asking about what are your thoughts on the upcoming class of IPOs in 2019? Next month, we're probably going to have Lyft and Uber going public. Airbnb expected to go public later this year. Any of those gets you more excited than the others?
Well, I think Slack is also kind of slated to be in there, and they'll be in that class at some point. I think that's an exciting. All those businesses, they're very popular, and they're large businesses. One thing, historically, when we look at our results here at the Motley Fool, trying to find these businesses that are a little bit on the smaller side. So not the big, large billion-dollar plus, the so-called unicorns that have come public, but maybe a little bit smaller. And so many, like you said, Uber, the valuation at 60 billion or so, and Lyft, I think, is somewhere in the 20 or 30 billion range. So these are very large companies, and they have the potential to grow at very high rates. But generally, I try to find, when I think about growth companies, a little bit more on the smaller side. So those companies are all going to come out very big and large, high valuations and large sizes. They could be wonderful investments. We'll have to see how the financials play out. But they clearly are going after markets that are changing and evolving and growing, and that's a good place to start thinking about your research when you're trying to find really growth companies that over time should be able to deliver for your portfolio.
Jackie asks, what do you think about Nike? Nike, a few weeks ago, we were here in the studio doing a live Q&A, and one of the things we talked about, it was right in the wake of Zion Williamson blowing out his Nike sneaker. Shares fell a little bit. They got some bad press. Where do you think that company is?
I think Nike's in a great spot from a consumer appeal side, from a global branded side. I don't think the stock is that expensive. It doesn't grow as fast as these companies that we talked about earlier at the top line, but it's exceptionally profitable and a very solid management team. So when I think about that global appeal, Nike generally probably will not be as volatile as some of these technology stocks we've been talking about, yet they are utilizing technology more and more. They continue to grow around the globe. And their competitors really, they've had some stumbles. So like the likes of Under Armour, Adidas, or Adidas here in the United States is getting a little bit more traction now. But I think Nike's in a pretty good spot to do pretty well for the next 5 years.
Richard asks, with these monster growth stocks, how does one know when to sell? Great
question.
That's
a great question.
It's different for everyone because everyone's got a different financial situation. Obviously, one reason to sell any stock is if you need the money for something else.
That's right, and this could be a whole podcast for us talking about selling. And in fact, we probably already have done that. I think the first rule is think about not selling. Like if you need the money, like you said, those are some reasons to sell, and I would start with your worst performers and your least conviction stocks, rather than the ones that are winning. But certainly some of these stocks, as they appreciate, you may wonder about when to sell, or what are my selling principles. And I think generally I would urge you, try to sell as little as possible, try to transact as little as possible. And if you do need to sell, I would start with the ones that are underperforming. This is what I'm doing. Underperforming your portfolio, and maybe a smaller part of your portfolio to raise capital. Think about deploying in more of your winners rather than your losers.
A couple people asking about the so-called Fang stocks, Facebook, Apple, Amazon, Netflix, Google. Di asks, which Fang stock is the best buy right now? Jim asks, which Fang stock would you shy away from right now?
Oh gosh, two great questions. So I own Facebook, I own Netflix, and I think they're both good buys here. Facebook's been a little bit, has struggled obviously, but if you look at their past quarter, and I applaud Mark Zuckerberg for the direction that he is now thinking more towards private interactions as opposed to public ones. And I know you and Jason and I have had conversations about that on some of the podcasts. I think Alphabet, the investments they're making today, obviously they got some bad news from the EU. I don't think that was a huge surprise, but I think the optionality they have to invest. So the one that I think will be a fine company, just won't grow nearly as much, although I'm very excited to see what they announce next week, is Apple with the streaming service. That's going to be a really new development for them. They're pushing more and more into that. So these are businesses that can innovate at very high levels, and their balance sheets are things of beauty. They're so large, Chris, that these are companies that just are not going to generate nearly the kinds of returns that they have in the past.
I want to go back to a word you just used because I think it's particularly relevant to these companies, and it's optionality. Yeah. Because by virtue of the amount of cash on the balance sheet that Apple has, for the past decade, people have looked at Apple and said, well, they could ... They could go into this space, they could go into that, and technically that's true, again, simply by virtue of the cash. On the flip side, I look at companies like Alphabet and Amazon. They've demonstrated their willingness to explore optionality, and sometimes it doesn't really pay off. We saw the restructuring of Google into Alphabet a couple of years ago, and part of that was to give Wall Street and everyday investors a little bit more transparency into their so-called moonshot division. But it really does seem like Alphabet and Amazon, they've explored optionality in a way that Apple, it's not a knock on Apple, but Apple hasn't really explored it in the same way.
Well, you're right, Chris, and I think the way Steve Jobs built that company was just really from the inside, and he was so principled and dedicated, sometimes tough to work with, but and such a perfectionist on the product development inside the family of Apple that they've really decided or chosen to invest their capital that way. They earn $60 billion a year, Chris. They have $85 billion of cash on the balance sheet, and they have exceptional returns on capital. They generate so much money that they just can't invest it fast enough, which is why they've been buying back a lot of stock. Now they're putting a lot of money apparently into this different streaming service, which is much different than selling iPhones, which makes up 70% of their revenue. So it is a change for them, and the first big one I think we've seen since we've seen the iPod launched in the early 2000s. So it will be very interesting to see, but historically you're right, they have not been an acquisitive company where the other ones, whether you're Facebook or Google, and Netflix has not been an acquisitive company. They've just been able to grow because they've had this huge market opportunity. So Apple, I see this one really with slowing growth rates from the iPhone. We're at a little inflection point with Apple. That's also why the stock doesn't sell from a valuation perspective, doesn't sell nearly as expensively as the other ones.
Usha asks, is it too late to enter into the trade desk?
No, I don't think so. If you are investing into the trade desk, and this is a company that really specializes in one of the leader in programmatic digital advertising, so helping clients place ads all over the web, and moving more and more off the web into TV. And it's done exceptionally well and is continuing to grow at very high levels, led by Jeff Green, who was the founder and owns 11% of the stock. I don't think it is too late to get into the trade desk. When you think about, wow, the company is not as small as it was when we first found it, but the market opportunity they have and the changing market, I think it's not too late. However, with all these growth companies, Chris, one thing I do want to emphasize is that we have to understand that these will come with some volatility, because when they tend to miss earnings maybe, whether it's theirs or the analysts, the stocks will sell off very aggressively at times. So you just have to be able to withstand that in your portfolio and not get scared away from owning these businesses. And lastly, when you do buy them, just make sure you really are buying them with a 5, 10, 20-year time horizon. I'm not kidding. Like, think about this as a 20-year hold or a 15-year hold, because that's the way you're going to be able to sustain the volatility that will come with owning some of these growth stocks.
A few people asking about Tesla and a few more people asking about Square. Let's start with Tesla. Where is Tesla right now as you see it?
Oh gosh, I don't own the stock, and I know it has a lot of mixed opinions here inside the company. I think when you look at what Elon Musk is doing, you have to, I'm impressed with him just from the mission that he is taking on. The business, as it tries to continue to generate, it's actually been a very high growing sales company, but not profitable. So this is one of those really sales superstars over the last 5-10 years. Now they are starting to get a little bit more profitability. So I think if you want to be an owner of Tesla, by all means, I think you could buy the stock. That is one that is definitely going to be more volatile, and it'll be more volatile with every communication Elon Musk makes.
Well, and to the point you were making earlier about management, I mean, there are some businesses out there, some that we like a whole lot, that are even more of an investment in the leader of the company than they are in the business. And if you're investing in Tesla, you're all in on Elon Musk.
I think you have to be. I mean, you cannot, in this case, more so than maybe almost anywhere else, very hard to separate, even though they did separate the CEO and the chairman positions for him, very hard to separate Elon Musk from Tesla. As far as Square goes, I think the world of Jack Dorsey and what he is trying to build over there, and the payments position from a spot of that is getting a lot of attention and more and more competition, they have been able to really build a sustainable advantage, I think, that continues to grow over time, even though there's a lot of money going into the fintech space that is attacking and challenging them when it comes to payments. But what they're building is pretty, it's pretty exceptional.
Well, and sort of as we talked about earlier with Visa, I mean, Square is playing in that war on cash space. And from everything I've read in terms of customers, the people, the small merchants, the small businesses across America that use Square really seem to like it.
Well, I think so, and I mean, I'm using it more and more as I shop and see. Heck, I think I just paid when a dog groomer came to our house and to groom our dog, and I think I used a Square when I paid for her. So I mean, Square's a business that they can grow these gross payment volumes 25-30% per year. And the profitability curve is just really starting to show up. So this is a business that I could very much see over the next 5-10 years, this one moving into the hybrid hero level.
Edward asks, for small companies that are not yet profitable, what can people look at to value the business?
Sales growth. It really, Chris, it comes down to, I'm sorry, I didn't mean to cut you off there. I think it comes, for these companies, I mean, you think about Oktas and Appians, it comes down, ultimately it will come down to sales growth for them, because with sales growth, especially if you're in the technology space, you get a lot of the scale and the profitability will come down the line. And companies now from technology have the ability to be more profitable sooner than a lot of than maybe historically, and they have different ways to be able to manage that profitability. So it comes down to sales growth, and I think it comes down also, one thing I watch more and more is customer acquisitions. So making sure if the company does report customer acquisitions and the number of customers they have, making sure they can continue to add to their customer base, because it will show that they are in a market that A, is growing, hopefully, and then B, that they are actually growing with that market, or ideally taking market share.
Okay, we're going to have to wrap up in just a moment, but first, I know next week you're going on a well-deserved vacation.
Yes.
So kudos to you.
Thank you.
Have a great time.
Thank you.
The market still proceeds even though you're not going to be around.
That's right.
So let's get to a couple of stocks that are reporting earnings next week, and we're going to start with Ollie's Bargain Outlet. Fourth quarter report is going to come out next Tuesday. This is a stock, I mean, think whatever you want about how they maintain their, what are they,
semi-lovely.
The semi-lovely locations that they operate. Stock's up 35% over the past year.
Yeah, it actually has pulled back a little bit. It had a great run. I think as of last fall, it was up 70 or 80% for the year. This is a company, Chris, that operates about 300 of these semi-lovely stores that sell excess inventory and closeout inventory. And it's been able to grow. It's been one of these profitable and sales growing companies, a small company that's be able to continue to really have a niche that they have been able to excel at in almost all their stores are kind of on the Eastern Coast area. So sales estimates for the quarter coming up, 12%. That was a deceleration over a year ago, but earnings per share estimates to be up about 37%. Things that I may pay attention to, and that I will pay attention to, is they talked about this. This is like go to the store to buy your stuff. This is not an online purchase, but they did introduce a new application, a new app. So they want to see how their customers, their most loyal customer, Ollie's Army, almost 9 million consumers that have joined Ollie's Army, and how the app integrates with their buying habits. Will they expand? They say their market opportunity is maybe 900 companies, 900 locations. That's up from 300, but I want to see if they're going to expand that as they think to other spots they can grow the Ollie's company. So. Okay,
from bargain outlets to global consulting, very different business. Accenture reporting second quarter results on Thursday. This is a stock that's basically flat over the past year, although long term, Accenture's been a good stock.
Oh, and it's a really great business. It's a $100 billion company. They specialize in technology and strategic digital consulting for some of the largest companies in the world. That's things like they help with things like the Internet of Things or security, digital. So they talk a lot, Chris, about making these investments in the new businesses, and that's cloud and security and digital. So that now represents about 60% of their sales. So I want to see if they're going to expand that. That's up. That continues to grow. So I want to see how far they can expand that. And this is a business, Chris, that has more than $4 billion on the balance sheet with very little debt. They just announced an acquisition recently, Storm Digital, just I think this week or maybe last week. So I want to see, and they generate maybe $4 billion in earnings a year. So, and they buy back maybe $2.5 billion worth of stock. So for Accenture, I want to see how they continue to deploy that cash to be able to grow that business.
All right, have a great vacation next
week. Thanks, dude. Thank you.
Andy Cross, thanks for being here. Thank you so much for watching. Please click the subscribe button down below so you don't miss any of our live Q&As that we do here from Fool Global Headquarters. I'm Chris Hill. Thanks so much for watching. We'll see you next time.